Before we begin, a quick and important disclaimer. The information presented in this video is for educational and entertainment purposes only and does not constitute professional legal, financial, or tax advice. Divorce laws, asset distribution regulations, and alimony guidelines vary significantly from state to state and are subject to frequent legislative updates. Every individual case is unique, and the outcomes discussed here are based on historical trends and general case studies, rather than a specific prediction for your personal situation. You should always consult with a qualified attorney, a certified financial planner, or a licensed professional in your jurisdiction before making any major life decisions or signing legal documents. Please conduct your own due diligence and ensure you are working with a professional team tailored to your specific needs. Right now, in the United States, a quiet revolution is happening inside the American living room. For decades, the narrative of divorce was one of tragedy and failure, a social stigma that many women felt forced to avoid at all costs. But the data is telling a completely different story in 2026. Did you know that nearly 70% of divorces in the US are now initiated by women? When you look at college-educated women, that number jumps to nearly 90%. There is a massive demographic shift occurring where women are no longer just participants in the divorce process. They are the architects of it. However, while more women are choosing to leave, the financial and social landscape they are stepping into has become more complex than ever. There is a phenomenon known as the silver divorce explosion, where couples over the age of 50 are splitting at double the rate they were 20 years ago. For these women, the stakes aren't just about who gets the house. It is about surviving a potential 45% drop in their standard of living, while navigating a legal system that was often built for a different era of the American family. If you feel like the rules have changed, it is because they have. By the end of this deep dive masterclass, you will understand the exact demographic shifts triggering this wave, the modern financial pitfalls that catch even high net worth women off guard, and the strategic roadmap being used by women today to secure their autonomy without sacrificing their future. We are pulling back the curtain on why the modern American divorce is no longer just a legal ending, but a calculated demographic transition. To understand where we are today, we have to look at the historical trends that brought us here. For most of the 20th century, the American divorce landscape was defined by the concept of fault. You had to prove adultery, cruelty, or abandonment to even be granted a seat in a courtroom. That changed in 1969 when California passed the first no-fault divorce law, sparking a domino effect across the country. Fast forward to the current era, and we are seeing the third major wave of demographic change. This wave is defined by the breadwinner woman. Historically, divorce helped for women focused on securing alimony because the assumption was that the husband held the primary earning power. In 2026, census data shows a record number of women out-earning their spouses or contributing equally to the household income. This flips the traditional script. Now, women aren't just seeking support. They are often the ones fighting to protect their own pensions, 401ks, and professional practices. This shift in the demographic profile of the initiator means that the resources you need have changed. You aren't just looking for a lawyer. You are looking for a forensic accountant who understands how to value a female-led business and a strategist who can navigate the complexities of a gray divorce, where the assets are high but the time to recover financially is short. Let's look at a case study to illustrate this demographic shift. Consider the profile of a woman we will call Sarah, aged 54, living in a suburban U.S. metro area. Sarah represents the fastest-growing demographic in the divorce courts. She spent 20 years building a life, perhaps taking a few years off for childcare, but eventually returning to a high-level management role. Her children are now in college. In previous generations, a woman in Sarah's position might have stayed in an unfulfilling marriage for the sake of stability. However, the modern demographic trend shows that women in this age bracket are prioritizing self-actualization and long-term mental health over the stability of a fractured marriage. The problem Sarah faces is that the legal system in many states still utilizes formulas for asset division that don't account for the career gap penalty she took in her 30s. Even though she is a high earner now, her total lifetime earnings and Social Security contributions lag behind her spouse's. This is where the modern deep dive into demographics becomes vital. Historical trends suggest that while men's standard of living may actually increase or stay level post-divorce, women often see a sharp decline. Understanding this demographic reality is the first step in pivoting your strategy from a purely emotional one to a rigorous, data-driven financial defense. Another massive shift we see in the 2026 landscape is the impact of digital assets and the gig economy on marital property. 10 years ago, a divorce settlement involved a house, 2 cars, and a retirement account. Today, the demographics of American wealth have shifted. We are seeing more women who have built significant portfolios in non-traditional assets, from cryptocurrency to digital storefronts and intellectual property. The help available to women must now include technical literacy. For example, if a spouse has been mining Bitcoin or holding Ethereum in a cold wallet, a traditional attorney without a digital forensic background might miss hundreds of thousands of dollars in marital assets. We are seeing a trend where lifestyle analysis is becoming a mandatory part of the divorce process for women. This involves looking at the demographic spending patterns of the couple over the last 5 years to prove that the reported income doesn't match the actual outgoings. This is particularly relevant for women whose spouses are self-employed or work in industries with high cash flow or opaque bonus structures. Step by step, the first thing any woman in this changing demographic must do is a life audit. This isn't just about money. It's about mapping your current reality against the historical trends of your specific age group and region. If you are in a red state versus a blue state, the potential outcomes for your alimony or spousal maintenance can look radically different due to recent legislative shifts aimed at limiting the duration of support. In many jurisdictions, the trend is moving away from permanent alimony toward rehabilitative support, which is intended only to give the recipient time to become self-sufficient. For a woman who has been out of the workforce for 15 years, this trend is a significant risk factor. You must understand that the help you get needs to be forward-looking. It is not enough to get 50% of the assets today if those assets are not structured to provide for you in 20 years. We are seeing a move toward the use of certified divorce financial analysts, CDFAs, as a standard part of a woman's team. These professionals use actuarial data to show a judge exactly what a woman's financial life will look like at age 75, based on a proposed settlement today. This is the level of depth required in 2026. Beyond the numbers, the demographics of the divorce support system have also evolved. We have moved away from the scorched earth litigation of the 1990s toward more collaborative and mediated models. Statistics show that women who utilize mediation or collaborative law often report higher levels of post-divorce satisfaction and better co-parenting relationships. However, the caveat is that these models only work when there is full transparency. If there is a power imbalance, which demographic data suggests is still a factor in many traditional American households, then mediation can actually be a disadvantage. You need to identify where you fall on the power dynamic spectrum. Are you the in-spouse who handles the finances, or the out-spouse who has been kept in the dark? Modern divorce help for women is now heavily focused on financial empowerment training for the out-spouse, ensuring they have the same data set as their partner before they ever step into a negotiation room. We also have to address the social demographic of divorce. In 2026, the stigma is fading, replaced by a divorce-positive movement that views the end of a marriage as a transition rather than a failure. This has led to the rise of divorce coaches and support groups that focus on the second act. The data shows that women who engage with a community of others in similar demographic straits recover emotionally 30% faster than those who isolate. This social support is a critical component of help because it prevents the emotional tax, the tendency to make poor financial concessions just to get the process over with because of emotional exhaustion. As we continue this masterclass, we will dive deeper into the specific state-by-state variations, the tax implications of the latest federal rulings on property transfers, and the exact checklist used by top-tier legal teams to uncover hidden assets. The landscape is shifting, but for the informed woman, these demographic changes aren't just challenges. They are opportunities to redefine what the next 30 years of life can look like. The goal is not just to survive the divorce, but to emerge with a demographic profile that represents strength, independence, and long-term security. We are moving from the era of getting help to the era of taking command, and it starts with understanding the data behind the trends. To truly grasp the gravity of the shifting demographics in 2026, we have to look at the segment of the population that is currently rewriting the rulebook on domestic exits: the silver divorcees. For decades, the age bracket of 50 and older was considered the most stable demographic in American marriages. Couples who hit the 25-year mark were statistically likely to stay together until the end. But in 2026, we are seeing a complete inversion of that historical trend. Data from the most recent national surveys indicates that while divorce rates for younger generations are actually stabilizing or slightly declining due to later marriage ages, the rate for those over 50 has tripled since the 1990s. This is not just a statistical anomaly. It is a cultural and financial earthquake. Imagine a woman named Jennifer. She is 58 years old, living in a quiet suburb outside of Philadelphia. In 2026, Jennifer represents the face of the modern American divorce. She has been married for 32 years. Her children are independent, and she has spent the last 3 decades acting as the primary coordinator of the household while maintaining a steady, albeit secondary, career in education. To the outside world, Jennifer is entering her golden years. But internally, she is facing a demographic reality that her mother's generation could never have imagined. Jennifer is part of the first generation of women who possess enough independent financial literacy and social support to realize that 30 more years of an unhappy partnership is an unacceptable potential outcome. However, Jennifer's demographic faces a unique set of challenges that require a specific type of help. In 2026, the housing market remains a complex beast. For Jennifer, the family home is not just a place of memories. It is a massive illiquid asset with a mortgage rate locked in from years ago. If she sells the home as part of the asset division, she enters a 2026 rental or buying market where her monthly costs could triple. This is the gray divorce trap. Historical trends show that women in this age bracket often prioritize keeping the family home for emotional stability, but in doing so, they frequently sacrifice liquid retirement assets like 401ks or liquid brokerage accounts. Jennifer needs a deep dive into the long-term math. She has to consider that by 2035, the cost of healthcare and property taxes might outpace the growth of the home's equity. Help for women in this demographic now involves a heavy emphasis on future casting. It is no longer about who gets the house today. It is about who has the cash flow to sustain that house 10 years from now. Step by step, Jennifer's strategy must involve a comprehensive valuation of what we call the retirement cliff. In 2026, Social Security regulations and pension laws have become increasingly nuanced regarding divorced spouses. Because Jennifer was married for more than 10 years, she may be eligible for a portion of her spouse's Social Security benefits, even if he remarries. But the timing of the filing is critical. If she settles her divorce without a clear understanding of these federal guidelines, she could inadvertently leave hundreds of thousands of dollars on the table over the course of her retirement. This is why the modern demographic of divorce help for women has shifted from general practice attorneys to specialists who understand the intersection of family law and federal retirement statutes. Now let's pivot to a completely different demographic shift: the Millennial and Gen Z professionals. While the silver divorce is about asset preservation, the younger demographic is about asset protection and the recognition of non-traditional wealth. Meet Chloe, a 31-year-old software project manager in Austin, Texas. Chloe married in 2021, and by 2026, she is realizing the marriage is no longer viable. Unlike Jennifer, Chloe is often the primary or equal breadwinner. Her demographic is defined by the side hustle economy and the gig wealth phenomenon. Chloe doesn't just have a salary. She has restricted stock units, RSUs, from her tech firm, a secondary income from a digital consulting business, and a portfolio of fractional real estate investments through modern fintech platforms. For Chloe, the help she needs is fundamentally different. Historical trends suggested that the woman was the one seeking support. But in Chloe's case, she might be the one facing an alimony or spousal maintenance claim from a spouse who earned less. This is a demographic reality that many young women are unprepared for. In 2026, we are seeing a massive surge in the demand for postnuptial agreements. If Chloe didn't sign a prenup in 2021, she is now looking for help on how to negotiate a settlement that protects her future intellectual property and the growth of her tech equity. The case study of Chloe highlights a major trend in 2026: the digital asset audit. In a modern divorce, assets are no longer just in a bank account. They are in crypto wallets, digital storefronts, and even high-value social media accounts that generate ad revenue. A woman in Chloe's position needs a legal team that can perform a forensic digital sweep. Imagine if Chloe's spouse had been quietly diverting marital funds into a decentralized finance protocol or purchasing high-value digital collectibles. Without a tech-forward approach to divorce help, those assets would remain invisible. The demographic of women today is more tech-savvy than ever, but the legal system is often still playing catch-up. Taking command in 2026 means being your own best advocate by understanding where every digital cent is located. Another layer of this deep dive involves the shifting demographics of child custody and support. In 2026, the traditional every other weekend model is becoming obsolete. Most U.S. states have moved toward a default of 50-50 shared parenting. While this is intended to be equitable, it has created a new financial demographic for women: the undersupported mother. Historically, child support was calculated based on the primary caregiver model. With 50-50 custody, child support payments are often significantly lower or non-existent if incomes are similar. However, the data shows that women still perform a disproportionate amount of the invisible labor and secondary expenses for children, such as extracurricular management, healthcare coordination, and clothing. Help for women in 2026 now includes lifestyle allocation clauses in their parenting plans, ensuring that the hidden costs of raising children are shared as equitably as the time spent with them. We are also seeing a change in the demographic of who provides this help. The era of the lone wolf lawyer is over. In 2026, the most successful outcomes for women are driven by divorce pods. This is a multidisciplinary team consisting of a legal strategist, a certified divorce financial analyst, and a mental health professional who specializes in high-conflict transitions. This team-based approach is a response to the demographic reality that divorce is no longer just a legal event. It is a total life restructuring. For a woman like Jennifer, the pod helps her navigate the emotional toll of a 30-year split, while the financial analyst ensures she doesn't fall off the retirement cliff. For a woman like Chloe, the pod focuses on protecting her intellectual property and managing the fast-paced negotiation required in the tech world. But there is a darker demographic shift that we must address, one that requires a very specific and cautious approach. In 2026, the rise of financial infidelity has reached record highs. With the ease of opening digital accounts and the complexity of modern compensation structures, many women are discovering years of hidden debt or diverted assets only when the divorce process begins. This is not just a problem for the wealthy. It is happening across all socioeconomic brackets. The help available now must include a deep dive into debt liability. In many states, if your spouse takes out a secret loan or racks up credit card debt during the marriage, you could be held 50% responsible for that debt post-divorce, regardless of whether you knew about it. Understanding the historical trends of your state's community property versus equitable distribution laws is the difference between starting your new life with a clean slate or being buried under a mountain of someone else's financial mistakes. As we move forward, we have to ask the most critical question. Once you have identified the assets and understood your demographic risks, how do you actually secure the win in the courtroom or at the mediation table? The rules of engagement have changed, and the tactics that worked in 2016 are now considered outdated and even risky. In the next part, we are going to expose the specific legal loopholes that are currently being closed by state legislatures and the one document that almost every woman forgets to request during the discovery phase. A document that could reveal the true value of your spouse's future earnings. If you think the division of assets is just about what you own today, you are missing half the picture. The real battle is over the future value of the life you helped build. And we are going to show you exactly how to claim it. The concept of future value is perhaps the most misunderstood and overlooked aspect of the modern American divorce. Yet in 2026, it is the primary factor that determines whether a woman thrives or merely survives after the ink is dry. When most women walk into a lawyer's office, they are thinking about the present. They are thinking about the balance in the checking account, the current equity in the home, and the value of the cars in the driveway. This is a narrow view that historical trends show often leads to long-term financial instability. To take command, you must pivot your focus toward the enhanced earning capacity and the deferred compensation that your marriage helped build. Imagine a case study involving a woman named Maria in Seattle. In 2026, Maria is 38 years old. For the last 10 years, she worked a steady job in human resources while her husband, David, pursued a grueling medical residency and then a specialized fellowship in neurosurgery. Maria was the primary breadwinner during the lean years, covering the rent, the groceries, and the interest on David's student loans. Now, David is entering his peak earning years, with a base salary and bonus structure that puts him in the top 1% of earners. If Maria approaches the divorce looking only at their current assets, she might walk away with half of a modest savings account and a portion of their home equity. But that ignores the million-dollar asset sitting in the room: David's medical license and his future earning potential. In several U.S. jurisdictions, There is a legal concept known as enhanced earning capacity. While not every state treats a professional degree as a marital asset that can be divided, historical trends in 2026 show a move toward reimbursement alimony or professional goodwill valuations. Maria needs to argue that the marriage invested its collective resources, specifically her time, her income, and her sacrifice of her own career advancement, into David's career. The potential outcome of this strategy is a settlement that reflects the return on that investment. This is not about a guaranteed payout. It is about a data-driven argument that the future income stream is a product of the marital partnership. To do this, a woman in Maria's position must obtain a very specific set of documents that go far beyond a standard W-2. This brings us to the one document that almost every woman forgets to request during the discovery phase: the Long-Term Incentive Plan or LTIP agreement. In 2026, high-level corporate compensation is rarely just a salary. It is a complex web of restricted stock units, performance shares, and deferred bonuses that might not vest for 3, 5, or even 10 years. If you only look at last year's tax return, you are only seeing the money that has already hit the bank. The LTIP agreement reveals the money that is scheduled to hit the bank years from now based on work performed during the marriage. Imagine if Maria's husband had $1 million in unvested stock options that she didn't know existed because they weren't on the 2025 tax return. By requesting the summary plan description and the individual award agreements, Maria can ensure those future millions are included in the marital pot. Step by step, the process of uncovering future value starts with a forensic look at the career trajectory. You need to request the spouse's full employment contract, including any side letters or commission structures. You are looking for something called tail coverage or trailing commissions. For example, if a spouse is in enterprise software sales or insurance, they may receive residuals for years on a deal they closed yesterday. If that deal was closed while you were married, a portion of those future checks belongs to the marital estate. In the world of 2026, where many professionals are moving toward performance-based pay, this is where the real wealth is hidden. We must also talk about the demographic shift in how we value small businesses, particularly female-led businesses or solopreneur ventures. Let's look at a case study of Sarah in North Carolina, who built a successful digital marketing agency while her husband worked a corporate job. In a divorce, her husband's team might try to value her business based on its total revenue. But Sarah needs to understand the difference between enterprise goodwill and personal goodwill. Enterprise goodwill is the value of the business that exists because of the systems, the brand, and the team. Personal goodwill is the value that exists solely because of Sarah's personal reputation and relationships. In many states, personal goodwill is not a marital asset. If Sarah can prove that the business's success is tied strictly to her personal expertise, she may be able to protect the future value of her company from being divided. This requires a specialized valuation expert who can perform a multi-factor analysis of the business's revenue streams. Another critical area of future value is the Qualified Domestic Relations Order, or QDRO. This is a legal move used to split retirement accounts like 401ks or pensions. The mistake many women make in 2026 is accepting a flat dollar amount from a retirement account today, instead of a percentage of the future benefit. If you take $100,000 today, you lose out on the compounded growth and the potential employer matches that could turn that money into $500,000 by the time you retire. Furthermore, you must ensure the QDRO includes survivor benefits. Historical trends show that many women have lost their share of a former spouse's pension because they failed to specify that their payments should continue even if the ex-spouse passes away first. This is a technicality that can cost a woman her entire safety net in her later years. Now, let's consider the imagine-if scenario for the 2026 digital economy. Imagine you are a woman who helped your spouse build a significant social media presence or a YouTube channel. In 2026, these are not just hobbies. They are digital real estate with measurable future value. The help you need must involve a digital appraiser who can project future ad revenue, sponsorship deals, and affiliate income based on current growth metrics. We are seeing cases where a channel's back catalog of videos continues to generate thousands of dollars a month in passive income. That catalog was created during the marriage, and its future revenue is a marital asset. If you don't fight for a trailing interest in that digital content, you are essentially leaving a royalty stream on the table. Finally, we have to look at the tax trap of 2026. Not all dollars are created equal. If you are offered $200,000 in equity from the family home versus $200,000 in a traditional IRA, the home equity is far more valuable. Why? because when you sell the home, you likely have a significant capital gains exclusion, meaning that money is largely tax-free. When you withdraw money from that IRA, you will be taxed at your ordinary income rate, which in 2026 could be 25% or higher. A woman who doesn't understand the tax-affected value of her settlement is effectively taking a 25% pay cut without realizing it. Taking command means looking at every asset through the lens of what it will be worth after the government takes its share. The shifting demographics of divorce mean that the breadwinner is no longer a fixed role, and wealth is no longer just a number in a savings account. It is a dynamic, future-facing calculation. But even with the best financial data, there is one factor that can dismantle even the most strategic plan: the psychological warfare of the negotiation room. Many women are being outmaneuvered not by better math, but by a specific set of high-conflict negotiation tactics designed to trigger a settlement at any cost mentality. In the next part, we are going to dive into the negotiation traps of 2026, including the specific phrases meant to intimidate you and the false deadline tactic used to force women into signing away their future value. If you feel like the pressure is building, it's because it's designed to. We're going to show you how to break the cycle. To break the cycle of psychological and financial exhaustion, you must first recognize that the negotiation room in 2026 is often a stage for a carefully choreographed performance intended to make you blink first. The pressure you feel is not an accidental byproduct of a difficult situation. In many high-conflict cases, it is a deliberate strategic choice made by the opposing side to induce a settlement that favors their long-term wealth over your immediate peace of mind. One of the most prevalent negotiation traps we see in the current demographic landscape is the exploding offer. Imagine a woman named Emily, a 42-year-old marketing director in Chicago. She has been in a high-stakes mediation for 6 months. Her spouse's legal team delivers a comprehensive settlement proposal at 4:30 p.m. on a Friday afternoon with a strict clause stating the offer expires at 9 a.m. on Monday. This is a classic scarcity tactic designed to trigger a fight-or-flight response. By creating a narrow window, they are attempting to bypass Emily's logical brain and her professional support team, forcing her to make a decision based on the fear that this is the best she will ever get. Historical trends in American family law show that these deadlines are almost always arbitrary and are used to prevent a woman from performing the due diligence required to see the flaws in the math. The second trap is the litigation fatigue strategy, or what is often called the war of attrition. In 2026, the cost of legal representation in major U.S. metropolitan areas has reached levels that can quickly deplete a modest marital estate. If one spouse has significantly more access to liquid capital or corporate resources, they may utilize a strategy of filing endless motions, requesting redundant discovery, or canceling depositions at the last minute. The goal is to bleed the other spouse's legal fund until she is forced to accept a suboptimal settlement just to stop the financial hemorrhaging. For Emily, this looked like her spouse refusing to provide basic bank statements for 3 months, only to provide them in a disorganized digital dump of 10,000 unsearchable images days before a hearing. This creates a mountain of billable hours for her own team to sort through. To counter this, women are increasingly utilizing AI-driven legal discovery tools that can categorize and flag inconsistencies in large datasets in a fraction of the time it would take a junior associate. Taking command in this scenario means shifting from a reactive posture to a proactive one by leveraging technology to neutralize the advantage of a larger war chest. A third and particularly devastating tactic is the custody leverage trap. Despite the move toward 50-50 parenting as a demographic norm, some high-conflict litigants still use the threat of a protracted custody battle as a bargaining chip for financial concessions. They might have no genuine intention of seeking primary custody, but they know that the mere suggestion of it will cause an empathetic mother to trade away her retirement security or her share of the home equity in exchange for a peaceful parenting plan. Historical trends suggest that when these threats are called out in a court of law, they often crumble because they lack a factual basis in the best interests of the child. However, the psychological toll on the woman in the moment is immense. Help for women in 2026 now involves the use of parental coordinators and communication apps that create a permanent, unalterable record of all interactions. This digital trail can be used to show a pattern of behavior where the children are being used as pawns in a financial game, which often leads to unfavorable outcomes for the party attempting the manipulation. Let's look at a case study of how these traps are dismantled using the gray rock method, combined with a professional buffer. Imagine if Emily, instead of responding to the Friday afternoon deadline with panic, simply replied through her attorney with a one-sentence statement. The timeline provided is insufficient for a professional review of the proposal, and we will provide a counteroffer once our forensic analysis is complete. By refusing to engage with the artificial urgency, Emily reclaimed the power. She treated the high-conflict spouse like a gray rock, boring, non-responsive, and unshakable. This effectively neutralized the emotional payoff her spouse was seeking. In 2026, the most successful women in divorce are those who treat the process as a business merger or dissolution. They remove the emotional narrative and focus strictly on the data. They understand that every urgent text or final warning is just a data point in a larger pattern of negotiation. We also have to discuss the trap of the anchor. In psychology and negotiation, anchoring is the tendency to rely too heavily on the first piece of information offered. If a spouse starts the negotiation by claiming the house is only worth $500,000 when it is actually worth $800,000, they have set an anchor. Even if you negotiate them up to $600,000, you still feel like you won even though you are still $200,000 below market value. The demographic shift we see today involves women who enter negotiations with their own independent appraisals and valuations already in hand. They don't wait for the other side to set the anchor. They set the standard of truth based on third-party, objective data. This is why the life audit we discussed in earlier parts is so critical. You cannot be anchored if you already know the exact coordinates of your financial reality. Step by step, to break the cycle of these traps, you must establish a communication firewall. In 2026, this means all communication regarding the divorce happens through professional channels or dedicated apps. No late-night phone calls, no emotional emails, and no discussions during child handoffs. This prevents the emotional tax from being levied against you. Next, you must identify your walkaway point. Historical trends show that women who have a clear, data-backed understanding of their minimum requirements for long-term security are much less likely to be intimidated by false deadlines. This walkaway point is developed with your certified divorce financial analyst, who can show you exactly how different settlement scenarios will impact your lifestyle 10 years into the future. If an offer doesn't meet that minimum threshold, the deadline becomes irrelevant because the offer was never viable to begin with. Furthermore, we are seeing a rise in the use of bifurcation as a tactical move. In some states, you can legally end the marriage, the status of being married, while leaving the complex financial and property issues to be decided later. This can be a powerful tool for a woman who is being emotionally held hostage by a spouse who is dragging out the financial phase. By bifurcating the divorce, you gain the psychological freedom of being legally single, which often removes the spouse's primary lever of control. Once the emotional connection is legally severed, many high-conflict spouses lose the motivation to continue the financial warfare because they are no longer getting the emotional reaction they crave. As we move deeper into this masterclass, we have to look at what happens when the negotiation phase ends and the discovery of the hidden begins. While the negotiation traps are meant to make you give up, the discovery phase is where the most significant demographic battles of 2026 are won or lost. There are specific high-tech methods being used today to hide assets in plain sight, from offshore digital entities to lifestyle companies that exist only to shield personal income. In the next part, we are going to dive into the forensic blueprint. We will show you the 3 places where 90% of hidden marital assets are found in the modern American economy, and the specific questions your team needs to ask during a deposition to catch a financial lie in real time. The pressure is about to shift from you to them, and it starts with knowing exactly where to look. The hunt for hidden assets in 2026 is no longer a matter of checking under a mattress or looking for a secret bank account in the Cayman Islands. In the modern American economy, wealth has become liquid, digital, and often disguised as legitimate business expenses. To find what is being concealed, you must move beyond the standard financial affidavit and implement a forensic blueprint that targets the 3 specific areas where 90% of hidden marital assets are found today. The first of these is what forensic accountants call the shadow payroll. This is particularly prevalent in cases involving high-earning professionals or corporate executives. Imagine a woman named Kimberly, a 45-year-old architect in San Francisco. Her husband, James, is a senior executive at a global tech firm. On paper, James's income has remained remarkably consistent over the last 3 years. However, Kimberly notices that their lifestyle has subtly expanded, while their reported savings have stagnated. Through a deep dive into the discovery process, Kimberly's team uncovers the shadow payroll. This involves deferred compensation, unvested restricted stock units, and, most importantly, the manipulation of the bonus cycle. In 2026, Many companies allow executives to defer a significant portion of their performance bonuses into future years. James was intentionally deferring his 2024 and 2025 bonuses until 2027, effectively lowering his reported income during the window of the divorce proceedings. This is a common historical trend, used to minimize alimony and child support obligations. To catch this, your team must request not just the W-2s, but the underlying compensation agreement and all communications between the employee and the Human Resources Department regarding bonus elections. If a spouse is choosing to be paid less today to receive more tomorrow, that future value is a marital asset that must be accounted for in the present. The second pillar of the forensic blueprint is the digital vault. In 2026, the proliferation of decentralized finance and fintech apps has made it incredibly easy to move large sums of money out of the traditional banking system. Imagine if James had been taking small, consistent withdrawals from their joint account, amounts like $400, and moving them into a digital wallet or a secondary fintech app like a non-custodial crypto wallet. Over 3 years, those $400 increments can balloon into a six-figure hidden portfolio. Historical trends show that many women miss these assets because they are looking for large, suspicious transfers. The modern financial predator uses the death by 1,000 cuts method. Kimberly's team needs to perform a digital forensic sweep that includes looking for gateway transactions, small transfers to platforms like Coinbase, Kraken, or even newer 2026-era decentralized exchanges. Furthermore, they must look for evidence of hardware wallets, which look like simple USB drives, but can hold millions in digital currency. In a deposition, a critical question to ask is, do you currently possess, or have you possessed in the last 24 months, any private keys, seed phrases, or hardware devices used for the storage of digital assets? The reaction to this question is often more telling than the answer itself. The third area, and perhaps the most complex, is the shell game, which utilizes lifestyle businesses and pass-through entities. In 2026, the side hustle has evolved into a sophisticated way to shield personal wealth. James might own a small consulting LLC that ostensibly makes very little profit. However, upon closer inspection, Kimberly finds that this LLC is paying for business expenses that are actually personal benefits. This includes the lease on a luxury SUV, high-end travel disguised as client meetings, and even home office renovations that actually upgraded their shared living space. These are known as perks or add-backs. To dismantle the shell game, a woman must request the general ledger of any business her spouse has an interest in. You are looking for payments to vendors that seem out of place for the business's stated purpose. Historical trends indicate that business owners often use the Section 179 tax deduction to purchase heavy vehicles or equipment right before filing for divorce, intentionally lowering the business's valuation and the owner's personal cash flow. Your forensic accountant must add back these non-essential expenses to determine the true, available income for support calculations. Now let's talk about the deposition masterclass. The deposition is where the forensic data meets the human element. In 2026, the most effective strategy for women is the trap method. Instead of asking a direct question about a hidden account, you lead the spouse down a path of smaller, seemingly harmless admissions. For example, rather than asking, "Do you have a secret account at Bank of America?" which allows for a quick no, you ask, "Have you ever used your mobile phone to pay for a meal or a service in the last year?" When they say yes, you follow up with, "Which apps did you use?" If they mention an app that isn't linked to the disclosed marital accounts, you have just found a gateway to a hidden asset. Another high-stakes question involves the lifestyle gap. You ask the spouse to estimate their monthly personal expenses. Then you compare that number to their reported income. If their expenses are $10,000 a month but their reported take-home pay is $8,000, you ask the simple, devastating question, where did the other $2,000 come from every month for the last 3 years? This forces them to either admit to hidden income, gifts, or loans, all of which are relevant to the financial settlement. Historical trends show that when faced with the mathematical impossibility of their own testimony, many high-conflict spouses will finally move toward a realistic settlement to avoid a referral to the IRS or a full-scale forensic audit. Step by step, to implement this blueprint, you must first secure all digital devices and cloud access logs. In 2026, your digital footprint is your truest financial record. Second, you must hire a professional who speaks the language of modern finance, someone who knows that a loss on a tax return might actually be a gain in real-world wealth. Third, You must be prepared for the document dump. When the other side provides thousands of pages of unorganized data, they are hoping you will give up. Use AI-assisted review tools to flag every transaction over a certain threshold and every payment to an unknown entity. This is how Kimberly found the $500,000 James had moved into a consulting retainer with a shell company owned by his brother. The changing demographics of divorce help for women in America mean that you are no longer at a disadvantage just because you didn't handle the daily finances. The data is there waiting to be found, but finding the money is only the first half of the battle. Once you have exposed the hidden wealth, you enter the most dangerous phase, the asset valuation war. In 2026, the value of an asset is no longer a static number. It is a moving target influenced by inflation, tax law changes, and market volatility. In the next part, we are going to dive into the valuation trap, why the fair market value of your home or business might be a lie, and how to use the future-proofing clause to ensure your settlement doesn't lose half its value by 2030. We are moving from discovery to valuation, and this is where the biggest fortunes are won or lost. The hunt for hidden assets in 2026 is no longer a matter of checking under a mattress or looking for a secret bank account in the Cayman Islands. In the modern American economy, wealth has become liquid, digital, and often disguised as legitimate business expenses. To find what is being concealed, you must move beyond the standard financial affidavit and implement a forensic blueprint that targets the 3 specific areas where 90% of hidden marital assets are found today. The first of these is what forensic accountants call the shadow payroll. This is particularly prevalent in cases involving high-earning professionals or corporate executives. Imagine a woman named Kimberly, a 45-year-old architect in San Francisco. Her husband, James, is a senior executive at a global tech firm. On paper, James's income has remained remarkably consistent over the last 3 years. However, Kimberly notices that their lifestyle has subtly expanded, while their reported savings have stagnated. Through a deep dive into the discovery process, Kimberly's team uncovers the shadow payroll. This involves deferred compensation, unvested restricted stock units, and, most importantly, the manipulation of the bonus cycle. In 2026, many companies allow executives to defer a significant portion of their performance bonuses into future years. James was intentionally deferring his 2024 and 2025 bonuses until 2027, effectively lowering his reported income during the window of the divorce proceedings. This is a common historical trend used to minimize alimony and child support obligations. To catch this, your team must request not just the W-2s, but the underlying compensation agreement and all communications between the employee and the Human Resources Department regarding bonus elections. If a spouse is choosing to be paid less today to receive more tomorrow, that future value is a marital asset that must be accounted for in the present. The second pillar of the forensic blueprint is the digital vault. In 2026, the proliferation of decentralized finance and fintech apps has made it incredibly easy to move large sums of money out of the traditional banking system. Imagine if James had been taking small, consistent withdrawals from their joint account, amounts like $400, and moving them into a digital wallet or a secondary fintech app like a non-custodial crypto wallet. Over 3 years, those $400 increments can balloon into a 6-figure hidden portfolio. Historical trends show that many women miss these assets because they are looking for large, suspicious transfers. The modern financial predator uses the death by 1,000 cuts method. Kimberly's team needs to perform a digital forensic sweep that includes looking for gateway transactions, small transfers to platforms like Coinbase, Kraken, or even newer 2026-era decentralized exchanges. Furthermore, they must look for evidence of hardware wallets, which look like simple USB drives, but can hold millions in digital currency. In a deposition, a critical question to ask is, do you currently possess, or have you possessed in the last 24 months, any private keys, seed phrases, or hardware devices used for the storage of digital assets? The reaction to this question is often more telling than the answer itself. The third area, and perhaps the most complex, is the shell game, which utilizes lifestyle businesses and pass-through entities. In 2026, the side hustle has evolved into a sophisticated way to shield personal wealth. James might own a small consulting LLC that ostensibly makes very little profit. However, upon closer inspection, Kimberly finds that this LLC is paying for business expenses that are actually personal benefits. This includes the lease on a luxury SUV, high-end travel disguised as client meetings, and even home office renovations that actually upgraded their shared living space. These are known as perks or add-backs. To dismantle the shell game, a woman must request the general ledger of any business her spouse has an interest in. You are looking for payments to vendors that seem out of place for the business's stated purpose. Historical trends indicate that business owners often use the Section 179 tax deduction to purchase heavy vehicles or equipment right before filing for divorce, intentionally lowering the business's valuation and the owner's personal cash flow. Your forensic accountant must add back these non-essential expenses to determine the true, available income for support calculations. Now let's talk about the deposition masterclass. The deposition is where the forensic data meets the human element. In 2026, the most effective strategy for women is the trap method. Instead of asking a direct question about a hidden account, you lead the spouse down a path of smaller, seemingly harmless admissions. For example, rather than asking, "Do you have a secret account at Bank of America?" which allows for a quick no, you ask, "Have you ever used your mobile phone to pay for a meal or a service in the last year?" When they say yes, you follow up with, "Which apps did you use?" If they mention an app that isn't linked to the disclosed marital accounts, you have just found a gateway to a hidden asset. Another high-stakes question involves the lifestyle gap. You ask the spouse to estimate their monthly personal expenses. Then you compare that number to their reported income. If their expenses are $10,000 a month but their reported take-home pay is $8,000, you ask the simple, devastating question, where did the other $2,000 come from every month for the last 3 years? This forces them to either admit to hidden income, gifts, or loans, all of which are relevant to the financial settlement. Historical trends show that when faced with the mathematical impossibility of their own testimony, many high-conflict spouses will finally move toward a realistic settlement to avoid a referral to the IRS or a full-scale forensic audit. Step by step, to implement this blueprint, you must first secure all digital devices and cloud access logs. In 2026, your digital footprint is your truest financial record. Second, you must hire a professional who speaks the language of modern finance, someone who knows that a loss on a tax return might actually be a gain in real-world wealth. Third, you must be prepared for the document dump. When the other side provides thousands of pages of unorganized data, they are hoping you will give up. Use AI-assisted review tools to flag every transaction over a certain threshold and every payment to an unknown entity. This is how Kimberly found the $500,000 James had moved into a consulting retainer with a shell company owned by his brother. The changing demographics of divorce help for women in America mean that you are no longer at a disadvantage just because you didn't handle the daily finances. The data is there waiting to be found, but finding the money is only the first half of the battle. Once you have exposed the hidden wealth, you enter the most dangerous phase, the asset valuation war. In 2026, the value of an asset is no longer a static number. It is a moving target influenced by inflation, tax law changes, and market volatility. In the next part, we are going to dive into the valuation trap, why the fair market value of your home or business might be a lie, and how to use the future-proofing clause to ensure your settlement doesn't lose half its value by 2030. We are moving from discovery to valuation, and this is where the biggest fortunes are won or lost. To understand why the fair market value of an asset in 2026 is often a mathematical illusion, you have to look at the intersection of high inflation, shifting interest rates, and the modern tax code. When a standard appraiser walks through a home or a forensic accountant looks at a brokerage statement, they are providing a snapshot of a single moment in time. But in the current economic demographic of America, assets are more volatile than they have been in 30 years. If you accept a settlement based on today's snapshot without accounting for the friction of liquidation and future tax liabilities, you are not receiving 50% of the marital pie, you are likely receiving closer to 35%. Imagine a case study involving a woman named Natalie, age 48, living in a high-growth corridor like Charlotte, North Carolina. Natalie and her husband have spent 22 years building a diverse portfolio. They have a primary residence valued at $1.4 million with a low-interest mortgage from the early 2020s, a joint brokerage account with $800,000 in index funds, and her husband's private consulting practice. In a traditional 2016-era divorce, the math would be simple. Add it up, divide by 2, and trade assets until the numbers match. But in 2026, Natalie faces the valuation trap. The first part of this trap is the real estate illusion. The appraisal says the house is worth $1.4 million. Natalie wants to stay in the home to keep her teenage children in their current school district. Her husband agrees to let her keep the house if he takes the $800,000 brokerage account and a portion of the business. On paper, this looks like Natalie won. To understand why the fair market value of an asset in 2026 is often a mathematical illusion, you have to look at the intersection of high inflation, shifting interest rates, and the modern tax code. When a standard appraiser walks through a home or a forensic accountant looks at a brokerage statement, they are providing a snapshot of a single moment in time. But in the current economic demographic of America, assets are more volatile than they have been in 30 years. If you accept a settlement based on today's snapshot without accounting for the friction of liquidation and future tax liabilities, you are not receiving 50% of the marital pie. You are likely receiving closer to 35%. Imagine a case study involving a woman named Natalie, age 48, living in a high-growth corridor like Charlotte, North Carolina. Natalie and her husband have spent 22 years building a diverse portfolio. They have a primary residence valued at $1.4 million with a low-interest mortgage from the early 2020s, a joint brokerage account with $800,000 in index funds, and her husband's private consulting practice. In a traditional 2016-era divorce, the math would be simple. Add it up, divide by 2, and trade assets until the numbers match. But in 2026, Natalie faces the valuation trap. The first part of this trap is the real estate illusion. The appraisal says the house is worth $1.4 million. Natalie wants to stay in the home to keep her teenage children in their current school district. Her husband agrees to let her keep the house if he takes the $800,000 brokerage account and a portion of the business. On paper, this looks like Natalie won. However, the forensic reality is different. To keep the house, Natalie must be able to afford the property taxes, insurance, and maintenance, which in 2026 have escalated at twice the rate of general inflation. More importantly, if Natalie needs to sell that house in 5 years to fund her retirement, she will face a massive capital gains tax hit on the appreciation that occurred during the marriage. When we tax affect the house, that $1.4 million asset might only be worth $1.1 million in actual spendable cash. Meanwhile, her husband's $800,000 in liquid stocks can be accessed almost instantly. Natalie has traded high-quality liquidity for a high-maintenance, illiquid liability. Step by step, taking command of the valuation phase requires you to demand a tax-affected balance sheet. This is a document where every asset is listed not by its market value, but by its net value after estimated taxes and sale costs. For example, if you are looking at a traditional 401k versus a Roth IRA, the traditional 401k has a hidden lien on it held by the IRS. Every dollar you take out will be taxed at your future ordinary income rate. If your projected tax rate in 2030 is 25%, then a $1 million 401k is only worth $750,000. If you trade a $750,000 bank account for a $1 million 401k, you haven't broken even. You've made a lateral move that leaves you with less buying power. Historical trends show that women often overlook the cost of basis. If you receive stock that was purchased 10 years ago at a very low price, you are inheriting the tax bill for all that growth. If your spouse keeps the stock purchased last month, they have no tax bill. In 2026, with the capital gains rates being a frequent topic of legislative debate, you must include a clause that requires the equalization of tax basis across all divided portfolios. This ensures that both parties share the future tax burden proportionally. Now let's look at the business valuation war. Natalie's husband's consulting practice is a service-based business. Historically, these were valued based on a multiple of earnings, but in 2026 we have to account for AI replacement risk and key person discounts. If the business relies entirely on the husband's personal relationships, its market value might be low, but its value to the holder is incredibly high because it generates $400,000 in annual cash flow. Help for women in this demographic now involves a sophisticated analysis called the capitalization of earnings method. Natalie's team must argue that while the business might not be sellable on the open market, it is an income-producing machine that was built using marital time and energy. Therefore, Natalie is entitled to a differential payment that compensates her for the loss of that future income stream. This leads us to the most critical tool in the 2026 arsenal, the future-proofing clause. In an era where the purchasing power of the dollar is constantly shifting, a fixed alimony or child support payment is a declining asset. If Natalie negotiates $6,000 a month in spousal maintenance today, and inflation averages 4% over the next 5 years, Her $6,000 will only buy about $4,900 worth of goods by 2031. To prevent this, your settlement must include a cost of living adjustment, or COLA, clause. This automatically ties the payment amount to the Consumer Price Index. Without this, you are essentially agreeing to a pay cut every single year. Imagine the what-if scenario for the 2026 housing market. What if Natalie keeps the house, but the local market corrects, and the value drops by 15% right after the divorce is finalized? To protect against this, women are now using true-up or sale trigger clauses. This means that if the house is sold within a certain time frame, the final division of assets is adjusted based on the actual sale price, rather than the estimated appraisal. This prevents one spouse from being stuck with the downside of a market shift, while the other walks away with guaranteed cash. We must also discuss the demographic impact of variable interest assets. In 2026, many marital estates include investments in private equity, hedge funds, or startups that have no clear daily price. The historical trend was to guess a value or wait for a liquidity event. Today, we use the in-kind division strategy. If an asset is too volatile or complex to value today, you don't guess. You divide the ownership percentage itself. If the startup goes public in 2028, Natalie receives her 25% share of the actual result. This removes the risk of being lowballed by a spouse who knows the company is about to have a major breakthrough. Step by step, you should also evaluate the opportunity cost of your settlement. If you take the stable, low-growth assets while your spouse takes the high-risk, high-reward assets, you are statistically likely to fall behind in wealth accumulation over the next decade. Taking command means demanding a horizontal slice of the marital estate. A piece of the cash, a piece of the real estate, and a piece of the high-growth investments. This diversification is the only way to ensure long-term financial survival in the 2026 economy. The complexity of these valuations is why the discovery of the hidden phase we discussed previously is so vital. You cannot value what you haven't found. But even once everything is on the table and properly valued, there is a looming threat that many women ignore until it is too late: the alimony cliff. In 2026, the laws around long-term support are changing faster than ever, and many women are finding that the support they relied on can vanish overnight due to specific termination triggers hidden in the fine print of their agreements. In the next part, we are going to expose the maintenance traps that are currently catching women off guard across the U.S. We will break down the remarriage and cohabitation clauses that are being used to strip women of their financial security, and the step-down provisions that could leave you with zero income just as you reach retirement age. The battle for the settlement is over, but the battle to keep it is just beginning. We are going to show you how to build an unbreakable shield around your future cash flow. To build that unbreakable shield, we have to address the most volatile part of the post-divorce era: the maintenance agreement. In 2026, the demographic reality is that permanent alimony is becoming a relic of the past. Across the United States, legislatures are aggressively moving toward durational or rehabilitative alimony, which is designed to be a bridge rather than a destination. If you are a woman who has spent decades outside the traditional workforce, this shift is the single greatest threat to your long-term autonomy. The battle to keep your settlement starts with understanding the specific termination triggers that are now being written into the fine print of almost every standard divorce decree. Imagine a case study involving a woman named Samantha, age 52, living in Florida. Samantha has been married for 26 years to a high-earning corporate attorney. As part of her settlement in early 2026, she is awarded $10,000 a month in spousal maintenance for a period of 10 years. To Samantha, this feels like a victory. It covers her mortgage, her health care, and her basic living expenses while she considers her next steps. However, hidden within her agreement is a standard cohabitation clause. In 2026, the definition of cohabitation has expanded far beyond just sharing a lease. Historical trends in family law now allow a pair to petition the court to terminate alimony if they can prove the recipient is in a supportive relationship. For Samantha, this trap snaps shut 18 months later when she begins dating. She is not married, and her partner does not live with her full-time. However, because they vacation together and frequently stay at each other's homes, her ex-husband's legal team uses social media data and private investigators to argue that she is in a quasi-marital relationship. In many jurisdictions in 2026, this is enough to trigger a modification hearing. The potential outcome is that Samantha's 10-year safety net could be slashed or eliminated entirely, leaving her with no income and a diminished ability to re-enter the workforce at 54. To build an unbreakable shield, you must negotiate for a specific, narrow definition of cohabitation that requires a shared permanent residence for a consecutive period of at least 12 to 24 months. Better yet, high-net-worth women are now pushing for non-modifiable alimony, where they trade a larger portion of a liquid asset today in exchange for a waiver of the spouse's right to ever seek a reduction in support based on lifestyle changes. Another looming threat in the 2026 landscape is the step-down provision. This is a clause that automatically reduces your support every 2 or 3 years, under the assumption that your earning capacity is increasing. For example, Samantha's $10,000 might drop to $7,000 in year 4 and $4,000 in year 7. The problem with this demographic assumption is that it ignores the career gap penalty. Data from 2026 shows that women re-entering the workforce after age 50 often face significant ageism and a skill gap that prevents them from reaching the income levels the court assumes they will hit. Step by step, your defense against the step-down is to link any reduction in support to actual income milestones rather than arbitrary dates. You can include a clause that states the maintenance will only decrease if and when you reach a documented gross income of a certain amount. This shifts the risk from you back to the payer. We also have to look at the maintenance security strategy. A settlement is only as good as the payer's ability and willingness to pay. In 2026, we are seeing an increase in alimony defaults due to market volatility and job displacement in high-paying sectors. If your ex-spouse loses their job or passes away, your alimony vanishes. To shield your cash flow, you must treat your alimony like a corporate debt. This means you must be the owner and beneficiary of a life insurance policy on your ex-spouse that covers the total value of the remaining alimony payments. Historical trends show that many women allow the ex-spouse to own the policy, only to find out years later that the policy lapsed because he stopped paying the premiums. In 2026, you should negotiate for the premium amount to be added to your alimony payment so that you can pay the insurance company directly, ensuring that your shield never drops without your knowledge. Furthermore, you need to consider disability insurance. If the payer becomes unable to work, the court will almost certainly grant a motion to reduce or terminate support. By requiring the payer to maintain a disability policy with you as the designated payee, you ensure that your cash flow continues regardless of their physical health. This is a level of depth that most standard legal teams miss, but in the 2026 economy, it is a mandatory component of a masterclass level exit strategy. Let's dive into a what-if scenario regarding the 2026 tax landscape. Since the sunset of the 2017 Tax Cuts and Jobs Act provisions, the way alimony is taxed has become a critical calculation. For all divorces finalized after 2018, alimony is not tax-deductible for the payer and is not taxable for the receiver at the federal level. However, many states have different rules. If you are in a state that still treats alimony as taxable income, you are effectively losing 20 to 30% of your support to the government. Taking command means performing a net-net calculation. If you need $5,000 to live, you must negotiate for a gross amount that leaves you with $5,000 after state taxes are paid. There is also the demographic shift toward the Alimony Protection Trust, APT. This is a sophisticated tool being used in 2026 by women who want to remove the human element from their support entirely. Instead of receiving a check from an ex-spouse every month, a lump sum of capital is placed into an irrevocable trust managed by a third-party fiduciary. The trust then pays out the monthly maintenance to the woman. This removes the risk of the ex-spouse forgetting to pay, using the money as a tool of control, or filing for a modification every time they have a bad quarter at work. While this requires a higher level of upfront asset division, the peace of mind and security it provides are unparalleled in the modern era. As we look at the broader demographic of women in America, we also see the rise of the Social Security swap. If you were married for more than 10 years, you are entitled to claim benefits based on your ex-spouse's earnings record, provided you remain unmarried. In 2026, many women are finding that their ex-spouse's benefit is significantly higher than their own due to the lifetime earnings gap. However, if you remarry before age 60, you lose this right. This is a massive financial trap for women in their 50s. Help for women in this category now includes a Social Security equalization payment in the divorce settlement, a cash payment that compensates the woman for the potential loss of those federal benefits if she chooses to remarry later in life. Taking command of your future cash flow means moving away from the idea that you are being taken care of and moving toward the idea that you are managing a diversified portfolio of income streams. Alimony is just one piece. The others are your share of the retirement accounts, your independent earnings, and the growth of the assets you secured in the valuation phase. By building this multi-layered shield, you ensure that no single event, a job loss, a remarriage, or a change in state law, can topple your financial house. But even with an unbreakable shield around your money, there is one final piece of the puzzle that determines your ultimate success. As we move into the final part of this masterclass, we are going to talk about the new demographic profile. This is the stage where you transition from being a divorced woman to being a wealth builder. We are going to reveal the post-divorce portfolio strategy that top financial advisors are using in 2026 to help women turn their settlements into generational wealth. We will show you how to reindex your life for growth, how to handle the sudden wealth syndrome that affects many women after a large asset split, and the specific moves you need to make in the first 90 days post-decree to ensure your trajectory is permanently upward. The legal battle is the end of the old life, but the strategic rebuild is the beginning of the new one, and the best is yet to come. The first 90 days after the final decree is signed are often the most dangerous for a woman's long-term financial health. Historical trends show that many women, exhausted by months or years of litigation, fall into a state of administrative paralysis. They have the piece of paper that says they are divorced, but they haven't done the heavy lifting of decoupling their digital and financial lives. To ensure your trajectory is permanently upward, you must treat the first 3 months as an operational cleanup. This starts with the title and deed transfer process. If you were awarded the family home, simply having the decree is not enough. You must execute a quitclaim deed and file it with the county recorder to ensure the property is legally in your name alone. Simultaneously, you must contact your mortgage servicer. If the mortgage is in both names, you typically have a specific window to refinance the loan into your name or prove to the lender that you have the independent means to carry the debt. In the 2026 interest rate environment, this can be a significant hurdle. If you fail to do this, your credit remains tied to your ex-spouse's financial behavior, a demographic risk that has historically led to thousands of women being unable to secure future loans because of a former partner's missed payments. The next pillar of the 90-day reset is the beneficiary audit. Imagine a case study involving a woman named Olivia, who finalized her divorce in early 2026. She won a significant portion of her ex-husband's life insurance and retirement accounts. However, Olivia neglected to update her own beneficiary designations on her employer-sponsored 401k and her separate life insurance policy. 2 years later, a medical emergency occurs. Because she never updated those forms, the legal default in many states would still direct those funds to her ex-spouse, regardless of what the divorce decree says. In 2026, many financial institutions have automated systems, but they do not automatically scrub your beneficiary list based on a court order. You must manually submit the change of beneficiary forms for every single account, including POD, payable on death, bank accounts, and brokerage firms. This is a step-by-step requirement to ensure your wealth stays within your intended lineage. We also have to address the psychological demographic shift known as sudden wealth syndrome. For a woman who has spent years in a high-conflict marriage where finances were used as a tool of control, receiving a lump sum settlement of $500,000 or $1 million can be overwhelming. Historical trends suggest two common but risky reactions: fearful hoarding or impulsive spending. Fearful hoarding leads to keeping large sums in low-interest checking accounts where inflation eats away the value. Impulsive spending, often driven by a desire to reclaim a sense of luxury or to overcompensate for the children's emotional stress, can deplete a settlement in less than 36 months. To manage this, women in 2026 are utilizing a cooling-off period. During the first 6 months, the rule is to make no major purchases and no permanent investment decisions. Instead, the funds are placed into a laddered system of high-yield savings accounts or short-term treasury bills. This provides the safety of liquidity, while allowing the emotional dust to settle. By the time the cooling-off period ends, you have transitioned from a state of survival to a state of strategic planning. Once you have stabilized the assets, it is time to move into the post-divorce portfolio strategy. In the marital era, your investments were likely indexed for the collective goals of a couple. In 2026, your individual demographic profile requires a different approach. If you are 55, your risk tolerance and your time horizon for retirement are distinct from what they were as a pair. You must reindex your life for growth. This involves working with a fee-only fiduciary to build a portfolio that accounts for your specific tax bracket as a single filer. In 2026, the tax brackets for single individuals are narrower than for married couples, meaning you might hit a higher tax rate sooner. Your portfolio should prioritize tax-efficient growth, utilizing instruments like municipal bonds if you are in a high-tax state or Roth conversions to minimize the future bite of the IRS. Step by step, you must also rebuild your independent credit identity. If you have spent 20 years as an authorized user on your spouse's cards, you may find that your individual credit score is thin or non-existent. In 2026, your credit score is your passport to the economy. Start by opening 2 secured credit cards in your name only, using them for small, recurring utility payments, and paying them off in full every month. Within 6 to 12 months, this creates a data trail of individual financial responsibility. This is crucial for the modern woman who may want to start a business, buy a new property, or even secure a lower premium on her independent auto insurance. Identity reinvention is the final and perhaps most profound demographic shift. In 2026, we are seeing a record number of women over 45 utilizing their divorce settlements as seed capital for what sociologists call an encore career. This isn't about working because you have to. It's about working because you finally have the autonomy to pursue a professional identity that was sidelined during the marriage. Whether it's launching a boutique consulting firm, investing in a franchise, or returning to school for a specialized certification, the help available for women now includes vocational coaching as a standard post-divorce resource. Data shows that women who engage in a professional reboot post-divorce report higher levels of long-term life satisfaction and financial security than those who attempt to return to their premarital career paths. Imagine if Olivia, our case study, used a portion of her settlement to certify as a mediator herself. By 2027, she is no longer defined by her divorce. She is defined by her expertise in helping others navigate the same path. This is the ultimate potential outcome of the Deep Dive Masterclass approach. You aren't just surviving a legal ending. You are architecting a new demographic profile for the American woman. One that is financially literate, digitally secure, and professionally empowered. As we conclude this series, remember that the demographics of divorce help in America have changed because women have demanded better data, better strategies, and better outcomes. You are no longer a passive participant in a system designed to divide you. You are the lead strategist in a process designed to define your future. The historical trends of women losing half their wealth are being replaced by case studies of women who use the transition to double their autonomy. You have the forensic blueprint, you have the valuation tools, and you have the psychological roadmap to break the cycles of the past. The first 90 days were about protection. The next year is about growth. The rest of your life is about legacy. Every document you signed and every asset you fought for was a brick in the foundation of this new life. In 2026, the most successful women in America are those who realize that while a marriage may end, their financial and personal evolution is only getting started. You have taken command of the data. Now it is time to take command of the world that data has built for you. The era of the informed, independent woman isn't just coming. It is already here, and you are its new face.